Let's talk to Wale Olusi now, who's an investment analyst with AfriInvest, to get his perspectives on this. So good morning to you, Wale.
Good morning, Harry.
It's great to have you on the show. So let's take a look at yesterday's trading. Did it meet your expectations, or did it fall short of your expectations?
Well, but thank you for having me, Harry. Here. Yesterday wasn't above expectation. The performance of equities was largely expected. I mean, a lot of orders were not filled on Monday, so we actually expected that investors will continue selling. I mean, the market have rallied weeks before Tuesday and Wednesday yesterday, so we expected that some profit taking will continue. But for the fixed income market, we think that was well, maybe a little surprising, but if you look at the fact that there was a treasury bills auction yesterday, of course, investors were largely bullish, probably due to that. But the yields that were quoted wasn't, I mean, beyond expectation. So there wasn't too much surprise for us yesterday regarding what the market did generally.
Market, that must have come as quite a surprise. In 2 days, almost 700 billion naira has been lost from the market. Yesterday alone, we saw a 2.72% drop in the All Share Index. Market capitalization contracted about 258.59 billion naira. It seems as if basically this is what's going to continue for this week, maybe for the rest of the month.
Like I was trying to say yesterday, yes, it might continue, but we think there might be a change in tide if the I mean policymakers come out to give us exactly what they want to do. Because if you look at the rally that took place before what we saw this week, it was purely based on communication reforms and FX flexibility that was communicated from both the fiscal and the monetary policy arms of the economic management team. So we think if I mean CBN told us in a couple of days we will have modalities regarding what they want to do with FX. If that can come on time, if days don't turn to weeks and weeks to months, then maybe things might change. But in the absence of that, if speculation will continue to drive the market, and there's a huge likelihood that year to date will continue to something around double digits, and the market will continue very, very soft, and all you've just been saying is going to be more of a speculative trade of the marginal. But if the information that investors really require, I mean, to see what the outlook for the rest of the year will be, then there's a huge likelihood that tides might change and the market might return to a positive trajectory going forward.
So, Wale, how do you expect investors to play? What's your expectation? Which markets do you think they'll begin to favor? The bills, bonds, or equities? Or they'll just take a cautionary, trading stance on all the markets?
Well, I think if you look at the overall mood in the market at the moment, I think the question is caution. But depending on your risk horizon, I mean, for those that were really really, ready to take the risk when the market was really down. Some of those that bought at the bottom, they should be smiling to the bank at about last week. I mean, some of them will have made something in the range of 20.5%. So it's a question of your risk horizon. If you don't have the risk appetite to play medium to long term, it's a tricky time to play the market at the moment. But those that can, withstand the market for a medium to long term outlook, I think it's always a good time to buy the market. I mean, if you are buying on Friday, for example, it might not be that fantastic for you. But if you are buying today, most of the stocks that rallied last week, they are largely, getting back to what they were before the rally at the moment. So it might be a good time to, look at the perfect entry time that will meet your need and come in at, at those prices at the moment. But that should be done with caution because we want to see what CBN is doing because it looks like the real mover of the market at the moment is CBN's communication about FX and what exactly they want to do. That the earlier that comes, the earlier the tide will change. But in the medium, in the short term, I think your risk appetite should determine what you want to do. If you have the appetite to take the risk for medium to long term, you might target a price at comment at the moment.
Okay, so for the bonds, take your pick because we see a lot of investors favoring the well, the February 2020, all those bonds that are maturing in another 4 or 5 years. Do you think investors will continue to favor the short, intermediate, or the long end curves of the bonds market?
Well, when the risk environment is very tricky, like this, most general investors will look at the shorter end of the curve because they can easily come in and pull out. So until the outlook is clear, I mean, it's safer at the shorter end of the curve. But another way of looking at it is, what do you expect in another 1 to 2 years from now? If you can do that, then if I want to take a longer view of the market, but generally with the whole blurry outlook, I think it's just safer at the shorter end of the phone.
Well, thank you so much, Wale, for your perspectives this morning. Do have a profitable day.
Thank you for having me, Harry. Good morning.
Good morning to you. Wale Olusi is an investment analyst at AfriInvest, giving us his perspectives there.